More than $6 trillion in foreign exchange changes hands every day, and because exchange rates are based on countries' interest rates, economics and geopolitical conditions, rates are always fluctuating. Forex represents a dynamic global market. Learn more about Forex trading. Welcome Forex trading platforms. In general, retail clients have two choices when trading currencies: the futures market. A futures contract is an agreement to buy or sell a predetermined quantity of a commodity or financial instrument at a certain price and on a stipulated date. These contracts are traded on exchanges and volume is generally limited to major currencies. The foreign exchange market. Most foreign exchange transactions take place between institutional players, banks, brokers, and large intermediaries in what is called the interbank market. Understanding. The quote trading. The Forex market involves trading two different currencies against each other. The ratio of the two is what's known as a currency pair. The quote for a Forex currency pair references what it costs to convert one currency into the other. For example, if the US dollar and Canadian dollar pair is trading at 1.33, $1 USD is equal to 1.33 CAD. To find out how much it'd cost to buy a Canadian dollar, a trader would invert it $1 divided by 1.33 equals 0.7519. In this example, it costs a little more than 0.75 to buy a Canadian dollar. Here are some common terms a trader needs to know before trading Forex. PIP. A PIP is the minimum price fluctuation in a currency pair. For most pairs, the PIP is 0.0001, except for pairs that involve the Japanese yen. For JPY pairs, the PIP is 0.01. For example, a trader might see a quote in the British pound and USD pair of 1.4278. This means a pound costs $1.4278 PIP value. The value of a PIP is determined by the size of the trade. Futures contracts are standardized and their minimum fluctuation is called a tick. Currency futures have different contract sizes, but usually the size is 100,000 or 125,000. However, GBP USD futures are 62,500, so the tick value is $6.25. 62,500 times 0.0001 equals $6.25. If a trader bought one contract of GBP USD at 1.4343 and sold it at 1.4347, they'd have made 4 times $6.25 equals $25. In contrast, trading Forex allows for more flexibility. Retail traders can trade in increments as low as 10,000 units, much smaller than a futures contract. When trading on the Forex market, a trader might buy 20,000 units of EUR USD. Each PIP would be worth $2. 20,000 times 0.0001 equals $2. If a trader bought 20,000 units at 1.2320 and sold them at 1.2312, an 8 PIP loss, they'd have lost $16. Majors and exotics. Any pair consisting of the following actively traded currencies is known as a major US dollar: Japanese yen, euro, Australian dollar, Canadian dollar, British pound, Swiss franc, and New Zealand dollar. All currencies and pairs that involve them are known as exotics. Forex spreads on retail Forex brokerages. Trade costs are typically paid through the bid-ask spread. Also, bid-ask spreads aren't guaranteed. Major pairs typically have tight spreads throughout the day and night, but exotics generally have less liquidity and wider spreads. It's important to understand liquidity risks before trading Forex. In Forex, margin requirements vary as a percentage of the notional amount. Margin requirements are generally between 3% and 5% of the notional value. However, some pairs can go as low as 2%. Leverage is a double-edged sword because it can magnify both profits and losses. A small market movement can have a large effect, positive or negative, on the account's total profits and losses. Forex traders should consider their risk tolerance before qualifying to trade in the Forex or futures market. When a Forex trader holds a position from one day to the next, he earns interest on the currency he is long and pays interest on the currency he sells short. The difference between the two interest rates is considered the net funding rate. Some Forex traders ensure that they have closed their positions before the end of their own trading day to avoid the risk of losses due to the net funding rate. Traders choosing to hold a position the next day should consider potential losses and understand how funding rates work. Thank you for attending. See you soon.